to introduce two people that a lot of you know to tell you about what the state of the accommodation industry is at the moment. I'd like to introduce you to Adele Labine-Robin and Matthew Burke.
Let's see, while they're switching out the presentations, I'll say my hello and thank you for the opportunity to join you this morning. Matthew and I were sitting there just as everyone burst into the room, and there's a bit of a mix of emotion. We're not used to being in a room with quite this many people. I was counting heads, I was doing all kinds of maths about how many square meters and how many people and all of that. But then I settled myself. It takes a couple of times of going through this to settle myself and to kind of see that we are, in fact, on the up, as Adrian has said. It's really exciting to see the pace of activity pick up in our industry. It was a really quiet time. I had some really low moments over the last couple of years. But over the last month, I've had a couple of things happen. I'm going to point to Matt and say, Matt, you know what my joke is going to be. And so the amazing things that have happened in the last 3 weeks, I walked into a hotel and there was product in the minibar. Now, I'm not your best customer when it comes to the minibar, but just knowing that there's product in there makes me feel at ease and like I'm on a holiday or I'm on a business trip. So I was really excited about that. And then I went into a lounge and I could serve myself my own food. And I was like, I'm so ready to serve myself my own fruit and make myself a toasty if I want to. So there are absolute change, signs that change is afoot. However, there's a pretty big journey ahead. And, while I'll start out the morning with a whole series of charts and Matt's going to follow me up with a whole series of charts, I think we can put one foot in front of the other, knowing that that journey is started. What we're going to do today is I'm going to spend about 15 minutes, turn over to Matt, then I'm going to come on and provide a bit of an outlook at the end about the pace we think that recovery might take. These are the kinds of things I'm going to talk about today. There's things we know, there's things we know we don't know, and there's things we're pretty sure about. And so we'll go through those in turn. Now, the big number at the top is the amount of visitor expenditure that we've walked away from over the last 2 years. It's an outrageous number. You can cut it all kinds of different ways. But there's no doubt that as an industry, it's been a really tough couple of years. Don't worry, I don't spend a lot of time on the negatives. We're just going to have to acknowledge it because it's made a really significant impact to all of your businesses. I remember when they announced JobKeeper, and everyone was aghast that our government would spend $80 billion keeping people afloat during a time of tremendous uncertainty. And the loss in our industry alone is 1.5 times that so far. And we know that we're not back at 100%, so that number keeps going up every quarter where we turn over the data. The bucket that needs to be filled is really significant. So the bar chart is showing you, how much in every quarter we've been short just from a domestic front relative to the same quarter in 2019. What I want is that when we're looking at the June quarter, that we're almost to the top. That might be wishful thinking. We know that there's a journey ahead, but it's been a pretty massive couple of years. Now, this is a new view that we're looking at. And so your green is your capital city. So depending on where you're located, blue is a regional destination. So there's two things I want you to take away from this particular chart. One is the pie is smaller. We've gone from 140 billion industry in 2019 to 80 billion last year. And so the question mark is, what will 2022 look like? So the pie is smaller, but what's left has been redistributed. And so what we're seeing is loss of 58 billion, just in an annual number. Before the pandemic, cities received 56% of all the visitor spending. That's now dropped to just over a third. And so, the corollary there is that regions now account for 66% of all the spending in 2021. And so that might feel about right, depending on whether you have a property with a footprint in regional destinations. Now, I don't want you to think for a minute that that means that the regions are performing in aggregate at 2019 levels. Some are. Some have seen some really strong business demand as we've all left the cities as soon as we could, and wow, a regional destination close by fit the bill. But for a lot of regional destinations, it has also been a trying time. So what I try and do is get beyond the headlines. You know, as a country, our economy is stronger than it was before 2019. My job in a pack of economists is to try and tell them that our sector doesn't feel that way. And then when it comes to the aggregate of regions, yes, there are some really strong signs that they've performed well, but that's not across the board. Now here's something that we know to be true, is travel is part of the Australian DNA. In 2019, every person in the country took 14.3 trips. We're a massive nation of travelers. We travel twice as much as Americans do, and 1.5 times as much as our counterparts in New Zealand. And so we also travel overseas a lot. And so in 2019, almost 10 million trips were taken by Australians overseas. It's about the equivalent of 2 out of every 5 people. I think there was a thought at the start of the pandemic, before things really got real, that we thought we would redirect what we normally spend overseas to the domestic market. Well, we know that that did not happen. And as I go through a couple of slides, keep in mind how much Australians used to travel. I'll show you how much they traveled in 2021, when we could. And the task that we have as we plan and look forward is how much of this behavior will be sticky. Will we bounce back to the travelers we were pre-pandemic, or are we going to be different going forward? There's also the fact that we used to spend almost $6,700 per person traveling per year. It's a phenomenal amount. I think it gives us significant confidence that travel is a really important part of Australians' ethos and lifestyle, and so those green shoots are coming back. But the way we've traveled has shifted a little bit. And so on one side, you've got pre-pandemic, and on the other side, what we actually did in 2021. Now, 2021 was a year of starts and stops. And so we're not suggesting that that is representative of a new normal year, but it does point to a few things. We're taking less trips. Understandable, we were in lockdown for parts of 2021. We are spending about the same amount when we go on an overnight trip in a city. We're spending more when we go to regions. And so that's, I think, something to watch going forward. We've lengthened our trips a little bit. Now, 0.3, 0.2 might not seem like a whole lot, but in fact, for the last decade, before 2019, we're operating within a very narrow band. And so there's very little shifts over time. It's always about the same. So the fact that we've stretched our trip length, both in cities and regional areas, is something to watch for. Our share of visitor nights in hotels has gone down. And so that's the same if you're traveling to a city, or just a little bit down if you're traveling to a region. So we're traveling differently. Now, mode of travel arriving to cities shows the really significant shift that happened in 2021, and the one that I'm most curious to watch in 2022. Before, 41% of us, when we traveled to a city, it involved a flight. During 2021, only 25%. It's a massive change in traveler behavior. It's going to be, in part, just the sheer reduction in corporate travel. I work for a big, gigantic company, and the way we travel going forward as partners is going to change. We're going to travel less. It's a cost-saving measure. It fits with our commitments around sustainability, but we're also going to travel for longer. And so for people in the room, I think, don't panic that I'm only going to take 10 trips instead of 20. Each of those 10 trips will be meaningful, and I'm going to need to be hanging out at your properties for multiple days at a time, which suits me really well. I never liked a day trip, but now that's going to be pretty much off the cards. Now, I like this chart quite a lot. We updated it in the last couple of days with our last wave of data. So what you can see across all the 4 metrics is that traveler behavior is super responsive to what was happening in the pandemic. So that's a good sign. This is a good indicator. If you kind of draw a line through it, things are trending in the right direction. Adrian, they're trending up. Now, what I'd like to pull your attention to, however, is the axis. And so there's only one of those metrics that's broken through the 50% mark. And that, to me, is the reality check that while we are in an upward trajectory, that there's a fairly significant part of the population that's just waiting out 2022. And so everyone in this room, we're raring to go. We've been traveling when we could. But when you've got only 50% of people saying they feel safe flying right now, only 55% saying they feel safe staying in a hotel, only a third are planning a leisure trip in the next 3 months. That's not chickens bursting out of the coop. That is us being ready, but a significant portion of our population kind of waiting out 2022 and seeing what's going to happen. We can see on the final metric, you can see that increase over the last couple of waves in terms of our intention of traveling overseas for leisure in the next 3 months. The third metric is intention to travel here, and that one's flatlined over the last couple of rounds, and this is on a monthly basis. Now, breaking that down to what components of the leisure trip and where we're sitting on that. And so in the very top green line, and I'm gonna do a better job of differentiating those colors. That's gonna be hard for you guys. But we can see a flatlining over the early months of the year, and for all of these metrics, a little burst up over the last couple of months. And when Matthew comes on, he'll tell you about the strong results he's seeing over the last 3 weeks that give a further point of evidence. And so, are we any different to our counterparts around the world? What you're looking at here is last March and just recently this March. And this is our intentions to stay in a hotel as part of a leisure trip in the next 3 months. And so, great to see that bump up. 42% of us are saying we're likely to do that as part of our trip, and that's up. Across all of our key source markets, you can see that bounce up. The exception there is China. But it does demonstrate that strengthening of the market in the near term. Now, the confidence varies across different cohorts. So I thought I'd split it up based on age group and household income categories. Now, what we're seeing is across the board, if you're in the younger cohort, you've seen that bounce of confidence in the last period. And so you can see 50% are now feeling confident in staying in a hotel as part of a trip. Not surprisingly, when we look at household income, it's our higher household income cohort that is feeling more confident. Now, as we have the recovery of our sector coming in, the other thing that's nipping at our feet is this talk of inflation and this talk of the cost of everything going up. So what does that mean to us? What we've tried to do here is to pair up the plan to spend on travel with the concern around the price of everything going up and what that's going to mean for us going forward. Now, 50% of us are planning to spend on travel. 78% of us are worried about the cost of things going up. And so I think there's going to be some natural tension in the market there. We've seen it when we looked at our lower household income cohort, but we're not alone. And so across our key source markets, that dilemma of spending and higher prices is reflected, again, with the exception of China. That concern about the cost of everything going up, consistent across the place. And so it doesn't really matter if you're a young person or part of our older cohort, you're concerned about that. And the same is by household income cohorts. And so that concern is across the board, something to watch for. Now this is looking at whether our intentions to travel overseas will impact the domestic recovery at home. In the last wave, we can see that bounce up where 20% of us are saying we're likely to take an international trip. We're seeing that same bounce in a few other areas of our source markets, and so it is important to track and to use that as a factor when we look at how quickly the recovery might come back, and I'll have a few comments on that towards the end of the presentation. I thought I'd look at business travel, because for a lot of you it's going to be an important part of the mix. And so the likelihood of traveling for business in the next 3 months, we have a quarter of our travelers who are saying unlikely or very unlikely. And while there is still a little bit of a concern around travel and the safety of travel, that's reasonably modest. What's driving it, more importantly, is organizations changing perspectives on whether in fact they're going to travel less as a cohort, or whether in fact they're just slow to return for other reasons. But I do think as a general perception, we're expecting business travel to lag leisure travel. These things we're all sure about in the short term. They're the things that have kept us afloat when we could travel, and they're the things to anchor business and your demand on. The other thing we know is that we need our international visitors back. Every single one of them is the equivalent of 7 overnight domestic trips. And you remember how I told you we already take 14 trips a year? Asking much more of our Australian cohort is pretty silly, especially since we've seen that their behavior has shifted in the recent year. Will our international visitors travel differently? And so I think there's some interesting insights about the offer that you might be considering, and many of you will have shifted potentially already to reflect these trends. People are interested at arriving on direct flights. We're seeing some direct flights from new places, and that's really exciting to see from Rome and out of India. The trend of working from is something that's really prevalent in some of our international markets, and as we open up to international markets, may form an important part. The green bubble is what Australians think, and then the other blue bubbles are all of our core international source markets. And you can see we've got some for whom this is going to be a really important part of the mix. Now, planning last minute, what a headache. You are much more likely, well, you become very skilled at being quick on your feet and at planning quickly over the last 2 years, but it looks like your guests are going to keep this going for you. They're going to be telling you they're showing up, and you're going to have to flex. Imagine what that's going to mean from a staffing perspective and planning perspective and cost perspective. But it looks like of these 3 trends that we've been tracking, we've got more markets saying, yeah, this is an important part of the mix for me. Now, I'll hand over to Matthew after this, but I wanted to give you just a quick insight that we're actually not that different. I think a year ago when we looked at the rest of the world opening up and we weren't, we were really panicked. We were going to miss the boat, we were going to miss the first wave, everyone else was all back to normal. In some markets, that is a little bit true, but in aggregate, not really true. You know, from a Canadian perspective, and you might detect that in my accent, they're about where we are. They've gotten rid of the PCR, they're about to get rid of the rat, kind of like us. Labor shortages in the services industry and the hotel industry, very prevalent. They're tackling that same change. There is strong pent-up demand, but they're worried if it's going to last. And they're talking about insurance. That's in the public narrative around how are we going to protect Canadians when they travel overseas. Now in the US, some of the charts that I showed you, their 55 plus cohort is not traveling a whole lot. Their travel intentions are reduced, and that income divide is very real. They are seeing that work-life balance, that tension that we've seen here in people wanting to work from away for an extended period of time. In my firm, we're letting our staff return to home countries for a period of 6 to 8 weeks if they want as part of a leisure trip. That's just part of us and our employment offer. And so if that's being repeated across the world, there's a real trend there that we could be thinking about. In Europe, Prior to the really significant challenges we've seen over the last couple of months, they did have a burst out of the gate in 2021, but Delta and Omicron put an end to that, and there's much more modest numbers coming out of those markets. Singapore, an island country like us, pretty much saw all of their tourism sector wash away, even into 2021, and that's returning very slowly. The Middle East is possibly an exception, where they've had a really significant bulk up of return demand, and that's been around some really mega events, and their delay of the World Expo has allowed them to now take advantage of the return to travel that we're seeing around the world. So I'm going to pause there. Matthew's going to shift gears, and then I'll come back for just a few minutes at the end.
Thanks, Adele. And I think if we can just flip the presentations over, back to the, thank you. And I think really just picking up on what Adele was talking about around some of the global views is to start there. And what this is showing is February's occupancy and then the percentage change to 2019. So you can get a reflection of where it is. And you can really see that, for most of the world, occupancies are getting back to something of note. But then you can see in the lighter circles, I should say, you can see that there is still a significant margin to returning to 2019 levels, given that February is a reasonable month around the world, no matter the seasonality. What is very true and we would say divorced from demand is that typically we would see demand falls and average rate then follows to try and catch some of that demand and be extra competitive. What we've seen, because it was so stark, the fall away of demand, and so sudden, is that in actual fact, average rate has not fallen as far, and in fact, average rates are actually growing in many parts of the world as we seek the leisure and the surge in particular segments to that. And it's also in relation to some of the demand segments falling away and being non-existent for the time period. And we'll break that down on a more localized level. This is looking at indexing to 2019, and I'll probably go to sleep sometimes thinking about, I'm always talking about 2019, but this shows you the kind of 2021 rise that we saw as we were unvaccinated, but largely community transmission was negligible. We were beginning to travel, and we're now obviously in a vaccinated state, opening up and traveling, but we're still dealing with kind of a number of cases that has kind of flow-on impacts to the demand recovery. But you can really see that Australia is starting to get back to kind of the level it was this time last year. Is that runway then sustainable to much stronger levels? Conversely, you see New Zealand there, which has obviously been in a long kind of period of kind of isolation as a country, limited travel even within the country, and then also the fact that they're now starting to remove away quite a significant amount of demand that was attached to the quarantine program, hence kind of the larger dip we've seen more recently. And if you look at Australia more specifically and kind of put it in a month-on-month context of percentage change of occupancy, you can start to see that gradual kind of rise up as we started to open up, that kind of what turned out to be false hope of getting near enough to where we were this time last year, and then obviously the Delta wave, and then we're starting to get back. But you can see there that occupancy is still just shy of 40% down as a nation of where we were at the same time, 2019 for February. On the average rate front, it's a very different view, that you can see there that, average rate went backwards initially, but was very quick to kind of get back to a level of kind of normality of 2019 conditions, and then kind of has stabilized from then on. And really what is driving that is actually the nature of demand and also the price increases. It just depends on where that demand is landing and what pricing it can get, and I'll talk through that in a moment. This is now looking at separating the capitals to the regional areas in a demand context, comparing it to 2019 levels again, and then overlaying the average rate. And you can see there that consistently, even when regional properties had a lull in demand where there was a limitation on travel, it still was seeing average rates at above 2019 levels. And that's strengthened even further as that demand's been able to recover across the summer period. Conversely, you can see there that the major capitals, which is the bulk of our rooms across the country, more than half of the rooms in the country, is still well below 2019 levels. Breaking down by class, you can see that pretty much average rate across the board is pretty much on par with where it is. So some areas are going to be down and others, but in aggregate, they're pretty much there. And then the same can be said in terms of the occupancy as well, is that we're kind of 2/3 the way back, but in Australia at least, at a macro level, there isn't too much variation between whether you're a luxury hotel or an economy hotel in terms of how things have translated to that. It's more about where you're geographically located that then has a bearing on terms of whether you're a luxury or economy and the outcomes that then come through. So what is holding back Australia's occupancy from getting back to kind of normality as we would define it? Well, one of the things to look at is what's happening in midweek demand. And you can see there that I'm tracing back to the beginning of 2021, and this is just looking at Sunday to Thursday period. And you can see the kind of rise and fall of the national average that we saw on earlier slides. And we're kind of just coming up on where we were in 2021. We're at 78 points, so 22 points behind the same comparable week in 2021. We're making meaningful strides positively, particularly in the last month, that is getting stronger and stronger. Now, one thing that I've sort of been watching, and this is picking up on the Property Council of Australia, do a kind of how many people are actually sitting at their desks in their offices. And I've kind of been looking for some sort of correlation, because I think technically, if people are not in their offices, whether it's an internal meeting or an external meeting, if people are not in their offices, the likelihood of then kind of corporate travel that's following that is more muted. And we are starting to see, we're waiting for the March stuff to come out, but I'll be very intrigued to see the level of utilisation in offices and how that then relates to the growth we've seen more recently in accommodation. But I think there is a strong correlation between people being in offices and then what we're seeing in the rebound of weekday rates. Now, if we start to look at the cities themselves and see what's going on, so these are the big 4 cities in Australia by room size, and you can see that Perth and Brisbane sort of are out in front comparatively to where they were in 2019 to Sydney and Melbourne, and that is in part due to the nature of that Sydney and Melbourne have more demand components that go into it, and the requirement as much larger markets that they need all of those demand drivers to be able to be in the city to really function to getting back to the levels. You've also got to contemplate that Melbourne and Sydney were some of the strongest performing occupancy markets, so the bar is quite high for what they need to achieve, but they're definitely lagging their other 2 larger peers. The story is quite different for the rest of the capitals, where they have largely been more free and open for the majority of the last 2 years. They've also probably been, if I'm being biased, more supported in stimulation to keep that growth going on, whether it's in voucher campaigns, different tourism driving activities. They've been able to have more events, has meant that they're actually on par with or actually overachieving in Hobart's case. Now, obviously being smaller markets, you're less reliant on different demand segments to get to a level, but they are definitely showing a really strong positive signs thus far. To really kind of draw the kind of juxtaposition between capital markets and regional peers, you can see here just RevPAR for 2021, you can see that even with, like, for example, regional Victoria and the regional New South Wales markets, they were closed for like 5 months of the year, yet they almost got to 2019 levels, and they weren't even really trading for 5 months of that. And you can see just the huge difference in what was achieved for the capitals relative to their regional peers. So really, it is still about how do we stimulate demand in the capital cities. Just to talk about kind of leisure travel and breaking that down from just a generalized statement of it is just having a look at a few markets here, and you can see that for demand that's been tracking for over this sort of summer period, you can see that the smaller markets that are pretty much on par with where they're at. The Gold Coast has had a fairly strong run of it of late, but just given the sheer volume and size of that market, they haven't been able to quite get back to where they were, despite the fact that for most Australians, their only choice of a holiday was within Australia for this period of time. But there is some distinctions you can start to draw from this. So this is looking at Cairns and Gold Coast and why Cairns is a little bit slower in coming back. Now, taking the international market that both of these locations have traditionally benefited from, you can see that there is a distinct difference on 2 nights of the week, Friday and Saturday, because it is much easier for people in southeast Queensland, or for that matter in Sydney and Melbourne, just to pop up and have a weekend on the Gold Coast than it is to go up to Cairns for that. So even though the recovery is taking hold in Cairns, it is more muted for them because they haven't been able to get the same advantage that the Gold Coast has, because it has access to that sort of drive market demand. What is consistent throughout, and it doesn't matter what market I throw up here, but average rate is a star performer across the board. Even for the market of the Gold Coast size, and the fact that it's still not at the same occupancy levels, it's been able to drive that demand, indicating that, you know, really it's about people's propensity to pay than chasing the extra dollar in the competitive way that's been happening. How long that is sustained is going to be one of the questions. And that really draws to this. Across regional Australia, markets in 2021 saw extraordinary average rate growth. How long this can be sustained before it becomes an elasticity of demand question for operators and for consumers to say, well, actually, no, that's now got too expensive, I'm going to look at an alternative, particularly when other international destinations start to appear and people start to weigh up the total cost of their potential trips. Bringing it back to what's happening in sort of capital cities, and I'm using Sydney here as an example as to what's driving things at a more micro level. This is chasing the 4-week trailing average of weekday demand versus weekend demand. And you can see that consistently the Friday and Saturday nights is getting closer and closer to reaching what levels were in 2019. It is only just in the last 3 weeks that we've really started to see the midweek kind of start to turn a corner. And I've drawn a yellow bar across there to kind of line up. They're actually now ahead of the pace we were last year when we were unvaccinated but starting to travel. So really the trajectory is, can we now start to accelerate that even further? Now, one of the things that's interesting when you start to break down, and we'll pull the March numbers very soon, is it's actually not the shoulder nights of Sunday and Thursday that are really holding back that midweek demand. It's actually the core nights of Monday to Wednesday that is driving that, which is a really interesting thing that means that the speed of our recovery actually could be quite strong if we can get nights that we know people are more likely to stay on, getting back to make a meaningful difference to that. So I take that as an encouraging sign rather than a kind of open question of concern. Looking forward in terms of what occupancy is on the books here, you can really start to see that unfortunately Sydney gets blurred out. I said a couple of weeks ago that really Sydney needs to go out and find a couple of events, because you have a look at what can be stimulated here. Melbourne has the Formula One this weekend. They're pretty much going to be full. I think the first time in over 2 years that they will have occupancy over 90% for a night. And then you look out to Brisbane's got Magic Round in May, again another stimulant. So really that event, when there are events, people are willing to travel and spend, and also the average rate is following that. So really destinations do require that event demand to be stimulated, and how that can be done is obviously very advantageous to operators. One of the very encouraging things about Sydney's occupancy moving forward, and I've been talking about the last 3 weeks are quite encouraging in terms of actualised results. Part of the reason why is if you look at moving forward, and you can see that the teal bar is above essentially every day of the blue line, which is the same time last year for each of those individual days. And you can see most noticeably, more than on the weekends, is that the midweek demand is strengthening or is currently holding higher occupancy levels than what was being held same time last year, which in theory means if you keep the same booking pace as last year, you would end up with a higher actualised occupancy, which is very encouraging. And I kind of come to that conclusion because if I take a trend basis of the forward bookings on a running 4-week basis, and I trace this all the way back to the beginning of 2021, we are now surpassing, in terms of weekly pickup, the pace of it is now faster than what it was during kind of the sort of one period of time in 2021 where we were seeing things happening. It's now running faster. And when you take that on the basis that actually are holding occupancy for the next 28 days, so the percentage change is obviously based on a base number. If that base number is higher and you still have the same high percentage, is very encouraging to being that we end up with actualised higher occupancies. So the positive signs are building across each of the different components I've kind of just illustrated over the last 3 or 4 slides. Now that's sort of looking at the demand and occupancy view. What about what's happening in average rate? Now, kind of predating December 2021, the average rate for Sydney and Melbourne is incredibly skewed by the fact that a lot of the demand was filled by government-backed quarantine. But you can see the change as that is unwound into what's then actually taking shape. And the average rate to date is pretty much hovering around the levels that it was in 2019, which is an encouraging sign. I do think that it's got some volatility as different demand segments come back into the mix, which will have either a positive or negative impact to the overall average rate. And also as well, we will begin to see how the higher occupancy levels start to then impact pricing decisions as well in terms of yielding ability across it as well. But I do think it's got some volatility to come. A couple other quick things that I just wanted to talk through was when you break it down by accommodation type, what we've seen consistently across a lot of the markets is apartments have been running stronger occupancy levels, not only during the week, but also on weekends as well, than their hotel counterparts. Now, I've taken Brisbane, which is a market that's got, I think about 45% of its stock is actually apartments. That gap has only just started to change, which I take as a sign that service apartments have not dropped away. It's just that the hotel demand has started to strengthen back up. And I think that is a component of the fact that different demand segments are starting to enter the market, and that particularly that sort of corporate demand that is more kind of financial and more kind of that 1 or 2 night stay coming into it. I mean, that is just my interpretation of it, but I take that as a really encouraging sign. The other thing that we've been talking about for many years is that we've been under a development boom. And we're pretty much almost at the peak of that supply growth pipeline. We'll kind of peak at the end of this year, early into the new year. What is very true though is we've passed the peak of construction. In other words, the properties that were under construction are opening, but they're not then being backed up by new properties that have been in planning going into that construction phase. So we are seeing a slowdown in the future supply growth, where a lot of those projects that have been thought of are staying as thought bubbles for the time being. And obviously, as different supply metrics of development costs change, obviously that's going to influence it. In saying that different cities are at different trajectories of their supply growth pipeline, some have finished it, some are partway through it. But you can see here that the Gold Coast, Melbourne, and to a lesser extent Sydney, is where the greatest percentage of share of new inventory is going to come based on those properties that are actually under construction to that. Now, we've been talking about a lot of the regional demand being real huge beneficiaries of that. Well, is supply going to meet that? At the moment, not really, because only 10% of all properties in the country are actually in regional locations for that. So those in those markets probably are not going to have too much of a threat of the new supply too much. And the last thing I'll just finish off on before Adele really talks about Australia is just to look at an Asian-wide influence of what's happening in terms of with our partners at Tourism Economics, of our view of what may materialise. And really it speaks to the divide that you have between if you're a domestic orientated country and you can really drive your domestic market, the chances of your ability to get back to some degree of really strong performance is there. If you're highly exposed to international markets, then that pace of recovery is going to be a much longer journey to that. I'm not going to share any of the summary here, but the slides will be available and you can really digest that. The last thing I will leave with is that one thing that we importantly need to keep an eye on is that with inflationary pressures, ADR going up is a great thing, but if it's not going up at real rates, then that is obviously then impacting profitability, and with supply pressures coming in, that's going to be a continued factor. And the second thing I would say is as well is that with the labour impact of serviceability, is going to be interesting how that kind of morphs out over the course of the year in terms of what constraints does that put on demand moving forward. It's a very hard thing to conceptualise in terms of reality of what is happening, but it's something that we want to keep an eye on to see what impact that may be having on overall demand levels. So thank you, and I'll pass to Adele to get a bit of a view of where we think.
If I can get you to throw back to slide 19 in the previous pack, please. Now, fantastic. Now, I spent the first 6 months of the pandemic pretending there wasn't a pandemic. I stopped doing our hotel market forecast. It was an impossible task in that period of time. So what do you do when you can't forecast what will happen in hotels? You develop scenarios. It's kind of the classic response to the situation. And so we developed 3 scenarios based on a whole series of indicators. Long story short, this is where we landed. And so we had a mild, a harsh, which is still a pretty harsh word, and a severe scenario. And how have we tracked against those? And so 2020 saw us tracking even worse than our original scenario in the middle of 2020. 2021 saw us move towards the central scenario. And going forward, we're in the process, so this is a bit of a sneak peek, we're in the process of updating our forecasts for both domestic and international travel and for each of the hotel markets. That will come out in about 6 weeks' time. We think that, in fact, the domestic recovery is going to lag a little bit from what we're showing on this slide here, that we're likely to stay around that central perspective. I think we'll get to 80-90% would be, my educated guess at this point, but then claiming that last 10% is going to take a while. I think pent-up demand will get us close, and then there's going to be some nudge behavior, encouragement, and more of those vouchers that will be required to do that. Now, on the international front, much like our colleagues around the globe, 2024, 2025 is generally where we're pegging the full recovery to 2019 levels. There were 9.6 million people who came here. It's a phenomenal number. Sydney Airport's operating only at 20% from an international perspective. It's going to take a while to rebuild that muscle and all of those practices. We've lost a couple of months, with January and February being really flatlined compared to where our view was in the late part of last year. So we're still pegging kind of late 24, 25 based on all of the underlying variables, but the shape of the curve is going to change. And so I think the bounce that we would have liked to have seen in 2022 is going to be less pronounced, and it's going to stretch into 2023, moderated by that significant uncertainty around the inbound-outbound relationship. Now, late last November, when we had a look at what we thought the recovery across hotel markets could look like, this was our view. And so we kind of pegged the markets much along the lines that Matthew's walked you through, based on their level of exposure to a variety of international source markets. In Sydney, 45% of your hotel nights in 2019 were from international visitors. So there's pressure for the big cities, and then also your exposure to business travel, which will lag leisure to some degree. And so we see Brisbane and Perth recovering more quickly. Sorry about that. I'm French, I talk with my hands. And then Sydney and Melbourne being at the bottom of the pack. My view is between early December of last year and April of this year, we're going to switch some of those markets based on their recent recovery and on the supply that's come into the market over the short term. That was a look at occupancy. When it comes to rates, the story is reasonably the same, but what you can see is that they're all above that 2019 line. And it's a really interesting place to watch that we really have been able to maintain rates even though our hotels were less busy. And so it gives us a task in terms of rebuilding volume, but not that task in rebuilding expectations about what it's going to cost to stay in a hotel. At the same time, we've had a lot of great product open up around the country that are putting upward pressure on those rates. It's a lesson we've learned from other significant global setbacks, that you're not going to incentivize demand with rates when you're in a period as tumultuous as the one that we have gone through. So that brings us to the end of the Adele and Matthew show. We love doing this combination. Thank you, and hopefully you, the rest of your speakers won't overwhelm you with as many charts as Matt and I have done. So good luck.